Welcome to FP&A and Finance Insights. I'm Jack Alexander. The topic for this video is selecting pertinent key performance indicators. Before we get started, I just want to introduce the channel and this playlist to you and my objective. I've been blessed with a 50-year career in finance and accounting and am looking to share those learnings with the next generation of finance leaders. I've designed these to be short focus sessions on important topics. The playlists are listed there for you to see. Today we're operating under the Enterprise Performance Management playlist. And I'd point out that many of the topics, illustrations, and models that we'll be going through are based on the financial management textbook, not textbook, but professional series book in the upper right-hand corner. And that book comes with a website that has all of the models and dashboards and so forth included with it. So today we're going to talk about key performance indicators. And as I mentioned, this is part of the Enterprise Performance Management playlist. We had the overview, which is on this playlist, and I would encourage everybody to watch this first so that we have the appropriate context. We're going to just review that briefly today, and then we'll focus on selecting pertinent, and that's an important word. We really want to make sure we're focusing in on the best KPIs for our organization. And we'll have another video on building effective dashboards and then on evaluating business performance, including benchmarking. So we'll talk about the context and think about enterprise performance management, the big picture. Then we'll talk about guiding principles, be thoughtful, careful about what we measure, very important. We'll go through an illustration of how we might select KPIs for an organization to illustrate some of these. And we should start really with reflecting on Peter Drucker's infamous quote now, that that which gets measured gets managed, variations of that. But essentially, if we measure something, it's going to have an effect and it's going to call people's attention to that measure. Okay, so in the financial statement analysis video and also in the great debate over performance measures, we reflected on the financial statement analysis and the key financial metrics. This is just a great little summary, visual summary of key things like revenue and growth, profits and profitability, asset turnover, etc. And this is great, except by definition, the financial statements are lagging results. The period's over, the game's over, the score's in the books. So we talked about looking at things like return on invested capital or return on equity and being able to create return trees, an application of the DuPont analysis, so that we could go through each element of ROIC, like profitability and asset turnover, identify the components underneath that, and eventually work our way down to processes and activities that people could relate to and that, as importantly, will ultimately impact the financial results whenever we get around to closing the books. So the key is to integrate financial results and performance management, not two separate activities or functions, but they should be thought of holistically. Financial results, as we mentioned, they're lagging output, so relying on that as our performance management system is fraught with problems. It's like driving by looking in the rearview mirror. Instead, we should have our eyes focused on what's happening right now and what's coming at us down the road. We spoke about the fact that financial results are the result of internal business processes and how those processes interact with the external environment to yield financial results. Things like strategic planning, new product development, administrative processes, reporting compliance, revenue process fulfillment, people processes, extremely important, and things like the acquisition process. So we don't want to think about process management from a functional standpoint or department standpoint like accounting or marketing or sales. We want to be thinking about it in terms of these processes. Okay, we also talked about what we should measure. Before we just jump out there and start adopting measures, we should develop a context and understand what the mission and strategy of the organization is, what key strategic initiatives are out there, assess our performance, think about our current situation, do a SWOT analysis, what are the critical goals and objectives, large programs, and with all of that in mind, then we can move forward and think about the enterprise performance management framework. And again, this is covered in a little more detail in the initial video under enterprise performance management. We should also be thinking about key performance drivers whenever we select measures. Revenue and margins are always important, so we want to be thinking about those drivers and activities that are predictive and leading indicators. Significant cost drivers are very important. We always should keep a view on the outside, what's happening in the economy and in the market that could impact us. And then again, major investments, capital plans, as well as potential threats and risks. We also talked about, for corporations with a mandate to build shareholder value, that we should focus on long-term value. And so we introduced the value performance framework, starting with shareholder value and recognizing that long-term sustainable shareholder value is going to be a function of future expectations on revenue growth, competitiveness, operating effectiveness, capital management, and the cost of capital. We include intangibles in there as well, which are important. And so we can go underneath each of those drivers, for example, revenue driver, break it down between strategic acquisitions and organic growth, and then think about the processes that fuel that revenue growth and how we would measure it and ultimately improve it. Okay, so turning specifically to selecting pertinent performance measures, a few guidelines here. One is we got to make sure they're relevant and important. So we don't just want to select performance measures because somebody had a good idea or you read about it someplace, saw a LinkedIn post on it, or went to a conference where somebody's talking about it. They may in fact be good performance indicators. In general, we want to make sure that they're appropriate, relevant, and important for our corporation at this time and place. So objectivity is very important. We don't want them to be biased, and we want them to show a fair and balanced view of the organization's performance and opportunities. They have to be timely. Again, it doesn't do any good to hand somebody financial statements 3 weeks after the month has ended. They can't do anything about affecting the results for that period, and 3 weeks have elapsed into the next period. And so those are not very useful or helpful to the people that are operating in real time and making decisions and need to make game time adjustments. We want to have a balance of measures. First of all, we want to measure lagging performance, like accounts receivable DSO, a financial measure. We also want to have the leading indicators. How are we doing on past dues, revenue linearity, ultimate best practices or best DSOs that we could achieve? And so by balancing those, we would have a view into the future, and we would also select measures that balance and offset one another. For example, if we were trying to improve inventory turnover, and that's the only measure that we had on the dashboard, we would improve inventory turnover, but it might be at the expense of something very important like customer fulfillment and delivery times. So we want to make sure we have a balance in that respect too. Again, we want to emphasize leading indicators that will provide us the ability to pivot or make course corrections. put our foot on the gas pedal or tap the brake if indicated. Data integrity is very important. We have to be able to rely on the data that we're presenting. We want to make sure that it's clean and reliable. Nothing will crater KPIs, dashboards, and EPM if the data is constantly challenged and proven to be inaccurate. We want to have thoughtful definitions, and we'll talk more about this in a moment, but very important that we create specific definitions, that they be understood in terms of what they are and what they are not. In the right-hand corner, we've got a revenue process receivables dashboard, which has the lagging or result, DSO, and accounts receivable balance. And then it's got several of the important drivers or real-time measures in there, including things like revenue linearity, the level of past due receivables, and then, very importantly, process analysis, past due by root cause. And we'll talk more about that in improving performance, an upcoming video under EPM. So we need to be careful what we measure and report on. I use this performance measurement worksheet as I work towards building the series of KPIs. And to illustrate this, we'll look at asset turnover. So what is the measure? What's the objective of the measure? What are we trying to accomplish? How does it feed into the overall performance? Very importantly, how is it computed? What's the definition? We don't want people employing their own interpretations of the definition, and many of these KPIs can be defined differently. A great example of that is modifying what is an asset, for example, included in there. Is it invested capital? Is it net assets? Is it assets? Likewise, is it a single point average, that is year-end balance of accounts receivable compared to the revenue for the full year, or is it done on a quarterly basis, or is it a 12-point average of all the months within a year? Is it a leading or lagging indicator? What are the unintended consequences? Again, if we just put this in place without having a compensating measure, which on the right there, a compensating measure for asset turnover might be customer service levels, profitability, and revenue growth. We wouldn't want to have just a measure for asset turnover without having those other measures. We look at the next higher measures, ROA, ROE, ROIC, so that we understand how they fit in and relate. And then we look at the subordinate measures. What would be underneath this? Inventory turnover, or days sales of inventory, days sales outstanding, or fixed asset turnover. What processes does this measure cover? What are the key drivers? And who owns this, at least from a computational standpoint? And this is one that crosses many processes and activities, so perhaps it is the controller who owns this and looks down to the subordinate measures and processes for different ownership. Under the EPM video, we also talked about making the distinction between activity drivers versus output measures, and we used health as an example. So taking the weight, that is a result or an outcome measure, that is not going to help us manage our weight at all just by stepping on the scale. We need to think about and identify what the drivers of our weight might be. Things like the food intake, calories, fat, carbs, fiber, what are our activity levels, and then we want to present those activity measures along with the output measures so we can eventually build that strong linkage that shows that by reducing the food intake and by increasing activity levels, hopefully the scale rewards us with a lower numerical weight. So let's look at an illustration for 5 critical objectives for achieving the annual operating plan. It might be 7, it might be 10. When I was CFO, I always liked to identify, as we were pulling the plan together and finalizing it, what were the 10 most critical things that had to get done to achieve the operating plan and also achieve our long-term objectives. And I would present this to the management team and also to different segments of the employee group over time in different training groups. And I would get some interesting reactions where people were absolutely horrified by the fact that something that they were responsible for was one of the 10 drivers of overall financial performance for the corporation. So this is a good way to make sure that we're linking key performance indicators to overall corporate objectives. And so we start with listing those objectives and goals: revenue growth, improving cash flow, integrating a recent acquisition, strengthen human capital, and also monitor the external environment for threats and the way it might impact our performance. The drivers underneath each of those, we'll just look at a couple of these. For example, revenue growth. Revenue growth is going to be a function of new product introductions, retaining and growing customers, acquiring new customers, developing new channels, and of course what's happening in the market. If we looked at the outcome measures, we might and likely measure year-over-year growth rates, quarter-over-quarter growth rates, revenue CAGR over several years, the revenue contributed from new products perhaps, and revenue from new customers. And again, they're outcome measures. So what we really want to marry with those are the leading indicators of performance. So important to customer satisfaction would be on-time delivery percentage, measuring and surveying customer satisfaction, what revenue is in our product development pipeline, where do we stand on critical development projects, are we on schedule, how much revenue is going to be contributed by those, and are our revenue forecasts consistent with the current state of those development projects. The level of product returns, again, impacts customer satisfaction and future growth. Customer retention, do we have leakage there? New customer quotes would be a measure that would be good to help us understand whether we're on track to acquire those new customers. So let's go over and then look at improving cash flow. So again, some of the critical drivers there would be how well we're managing the supply chain management process as represented by inventory levels, receivables management, which is based on revenue process management and customer fulfillment, perhaps liquidating non-strategic assets, the cash flow measures we have there, the output measures, what's our operating cash flow, we might want to see what percentage that is of our operating profit to evaluate the quality of our earnings, what are our accounts receivable days sales outstanding, what is our inventory turns or DSI, I like to use days sales of the inventory because it's more intuitive to non-financial people. Revenue linearity, which is a big driver of working capital levels and the proceeds from sale of non-strategic assets. Then we can drill down and develop and monitor and plan and project things like on-time delivery percentages. If we're not happy with the level, what can we do to improve it, and how would that impact our accounts receivable and revenue growth levels? The same thing with product returns, credit terms, past due collections, supplier quality, manufacturing cycle times, and a project update on the liquidation of non-strategic assets. And so for these other three, it's a similar idea. Again, what are the critical objectives? Let's think about what's driving those objectives, what's going to be there to either make us successful or not reach those goals. What would be the ultimate outcome measures? And then what are the leading indicators that we can actively manage and measure in real time? So we'll look at a couple of examples for revenue growth and innovation. And again, these are dashboards, so we're jumping a little bit ahead. We'll talk in the next video on dashboards a little bit more about the construction and selection of measures to put on here. But you can see here that we've got revenue growth from prior year, which is a lagging measure, and then we've got the revenue contributed from new products, as well as the status of critical new development programs, on-time delivery, customer returns, past due orders. We can do the same thing then for supply chain and inventory management. The results would be inventory and DSIs. We could look at past due customer orders, the number of vendors, things like revenue linearity, how much excess and obsolete inventory we have on hand, and the number of inventory parts. Looking at an acquisition to make sure that it's being properly integrated and will deliver ultimately the financial results that we expected for it in the acquisition proposal. So a dashboard for a specific acquisition, we would look at acquired sales and maybe overlay that with the synergistic sales. We would look at the revenue synergies achieved, perhaps on an annualized basis compared to our goal. We could also look at the cost synergies achieved on an annualized basis. Key human resource retention is always important. Typically, we identify 8, 10, 20, 30 resources who are critical. They may be key managers, they may be key engineers, they may be key sales or marketing people, and we want to make sure that we incentivize them to stay on board. And if we saw leakage there, if we saw people jumping ship, that would be something we'd want to pull forward immediately and identify the causes and work towards rectifying those. Key integration activity reports, again, not a measure, but just an assessment of financial integration, HR benefits integration, key manager retention, R&D project rationalization, all these things that are going to ultimately wind up in the financial statements where it's too late to do anything about it to measure how the acquisition has performed. For human capital management, very important asset. It's not on the balance sheet, but it is an important asset. I think most people realize that. We don't always behave in a manner consistent with the importance of human capital in terms of performance, but we can look at things like training hours per associate, average days to fulfill exempt orders, the level of associate engagement, associate turnover, HR cost per employee, headcount versus plan, root cause of the turnover, again, looking into the drivers even of that measure, and what's our hiring mix, internal versus external. So a lot of really good indicators there and things that you can manage and influence that will help contribute to the performance ultimately put forth in the financial statements. This is an example of looking at external factors. We got a couple lagging measures. A lot of people look at GDP, but that comes way too late for us to do anything about it. It's a quarterly measure, and it comes a month or two after the end of the quarter in many countries, including the U.S. What's the unemployment rate, and how does that relate to our business? And again, that's a lagging indicator. So we want to include leading indicators. A lot of folks point to consumer sentiment as being a leading indicator. A lot of economic drivers are based on housing starts and household creation. So it's good to keep an eye on that. Labor participation is also very interesting and an indicator of a lot of things for business performance and also managing the workforce. And then again, we always include on these dashboards a list of takeaways and potential actions. So in summary, the overarching goal of corporations is to create value for shareholders. In the EPM video, we talked about not-for-profits or mission-oriented organizations and how we can adapt these to those specific organizations that aren't focused as much on creating value, although financial performance is still very important. So keep emphasizing that financial statements and ratios are lagging measures of performance. We want to cascade down from that financial performance to identify, measure, and work to improve on leading indicators, drivers of performance, and we want to be very careful what we select. We don't want to have 1,000 measures out there or 100 measures, and we want to develop measures and dashboards that cascade down from our overall corporate objectives. The value performance framework is a useful framework to construct a number of the dashboards and key performance indicators, and we'll talk about dashboards in the next video. So these are the other videos in the playlist. The Great Metrics debate is underneath FP&A tools, so you can take a look at that too. And also looking at financial statement analysis would be worthwhile. So I hope you found this beneficial. If you did, please like the video, subscribe to the channel, and tune into the other videos that we have. Thanks and good luck to you in your efforts.